If you're joining us on the platform on tastylive.com, welcome. Thanks for tuning in. Come over to the chat. Tell us what you're trading, what you think of this stupendous reversal in oil prices, down 12% from their opening highs yesterday on first call. Stocks end up pushing higher into the green, despite a little brief midday blip when Iran returns the favor, launching a proportionate number of missiles back at U.S. bases in Qatar. Ultimately, we see bonds trading to the upside for most of the session. Gold, silver meander around, but the story of the day is the resiliency of stocks and the pullback in oil here. We can go to the charts right away. It's a stock market that's closing out the session right near the highs, if not slightly off. S&P up 0.92%, NASDAQ higher by 0.96%. Your Russell's lagging. Well, it was lagging, actually. It's now higher by 1.06%. Good news there. We turn our attention to the bond market, where the long end of the curve, notes and bonds, both are seeing lower yields, higher prices over the course of today. Gold prices, they do, again, meander to the upside, but lose 3,400 once more. They were up by 1.1% or so yesterday at the open. But, Mike, it's the news of oil. Down 8.46%, absolutely crashing into the close. We see here that we're sitting right at session lows right now. In fact, we've now broken down through the levels prior to Israel attacking Iran on June 12th. Volatility is now down below the levels that we were at before Israel attacked Iran on June 12th. Mike, what do the bears have left to deter the bulls at this market right now?
Nike earnings. That's about it. I mean, this is crazy. We were talking about this a couple seconds ago, but this is the biggest. I think it's the biggest intraday range in oil since the Ukraine war started, too. So yeah. Crazy. But yeah, I mean, the fact that the E-minis and NASDAQ are just like, meh, and just ripping higher continuously, it's nuts. Absolutely nuts.
But they're not ripping higher continuously. They're stuck in the same range that they've been in since early May. They didn't care about this war starting. I don't know why they should care about this war ending, and they don't. They're not going anywhere. I mean, of course, they're up in today. There's no question about that, obviously. But look at a chart of the S&P, look at a chart of the NASDAQ, look at a chart of the Russell. If you're really bored, look at a chart of the Dow. Where have these things gone in the past, I don't know, 4 weeks? Absolutely nowhere. They are still in the same range.
Did the bearish arrow that you pull out of your quiver say, look at the Dow?
I mean, pick one. Pick an index. Where has it gone in 4 weeks?
Yeah, I think,
Mike, there's the idea that muscle tension and pain can resolve from mental anguish. And I'm thinking about that chat we were just having in the show, in the green room before the show, about Ilya getting his little acupressure mat that I recommended, of course. And I mean that
it hasn't arrived yet.
No,
maybe,
but like
maybe tomorrow I'll be less of a curmudgeon. Not today.
Well, I think my point here is that maybe your back pain would go away if you stopped being bearish.
Can't do it. In fact, I think were these markets to roll over, my back pain would be resolved almost instantly. Okay. I do have to say, somehow, after spending the night at a Metallica concert last night, it actually feels better. So maybe I should be doing more things to stress it and not less.
Yeah, all that activity, jumping around. I mean, Ilya, to your point, technically speaking, the market really hasn't made a substantial break yet. We are still very much in the sideways chop that's defined.
Yeah.
Almost going on a month at this point in time.
That's the thing.
Well, they don't care. There's a case to be made that maybe we're starting to test a breakout condition a little bit. I know you're not a lover of the diagonal lines like I am, but
you do have to pay attention, though.
We've started to clear out some of the former swing highs
there's some
in here.
Stuff that's going on here. Sure.
When you heard when you heard "Give me fuel, give me fire, give me that which I desire," were you thinking of how crude oil prices were going to be impacted there? Or
they didn't play that one yesterday. It's a 2-day show, and they promised not to repeat any songs from one day into the next. They played that one on Friday. I wasn't there for it.
Got it.
But they did not disappoint yesterday. I tell you what.
I mean, yeah, they're iconic. Incredible.
Incredible.
But yeah, I guess to further elaborate my statement on the even as NASDAQ, I would have thought that coming out of Friday and then going into the weekend news and seeing Bitcoin sub 100K, I could have sworn that we would have been down 100 points or more.
Oh, totally.
But
totally.
The fact that it is not happening is just surprising to me. Just in that context.
Episode. No, this entire episode, I think, speaks to that, Mike. I think you're absolutely right. This market did not want to pay attention to any of this whole thing. It wiggled down when it started. It wiggled up today when it seems to be off-ramping. The market seems to be not paying attention to any of this either which way.
Well, I mean, if we have to run a larger budget deficit, first off, a public sector budget deficit is a private sector surplus. So if the government has to run larger deficits to fund a war effort, that's just more money in the market's pocket. And it's not like you're sacrificing substantial revenues from S&P 500 or NASDAQ companies out of this. At the high end estimate, $575 million of revenues for S&P 500 companies for business related to Iran in fiscal year calendar year 2024, 0.003% of revenues. Whereas if you have to sustain any sort of significant war effort, that money goes right into U.S. companies' pockets without sacrificing anything on the revenue side because of the war. It's a sick game, right? But like there's a cold truth to the fact that dollars and cents as a result of us bombing Iran don't necessarily need to change hands outside of the fact that there's some, risk on, risk off sentiment and people speculating on people's various flows over the course of the session. But Mike, we get out of the session here basically sitting on the highs. The Nasdaq's up 1.04% right now. Mm-hmm. You mentioned Nike earnings being a potential roadblock this week, and I realize that was a facetious comment, but we're not really in a hardy part of the earnings calendar right now. So is there anything in particular in the days ahead, if it's a Micron, a FedEx, a Nike, do those move the needle for you whatsoever for the broader zeitgeist of where the indexes are heading?
Yeah, I mean, if you're looking for volatility, I think you can find them in Nike and Micron. FedEx is a little tougher because the FedEx expected move is significantly smaller than the other two, but it's still up there. I mean, 16-point expected move tomorrow after the close for FedEx. Relative to September, it's about half. So similar story in Nike and Micron, but Nike is interesting because I think out of those three, tariff implications are certainly highest there with a lot of production in Asia, but it's already down at the lows. I mean, like if you're bearish, how low do you think it's going to go? I think it's at that point where like we're already at COVID-19 levels in Nike prices. If you're playing it to the downside, it's cheap to do. But I don't think you can really make a killing on that. And then Micron is interesting because Micron's stock price has literally doubled from the low in April. And now we're sitting at this crazy recovery level. But, I think for this stock to keep going up above 125, 130, I think they just have to crush earnings and crush their forecast for the rest of the year. So if they don't do that, I think even if they post good numbers, I think you could see the stock sell off. So it's tricky, but I mean, like FedEx and Nike, if you're playing for price extremes and Micron too, but bullish price extremes, FedEx and Nike. Micron, I think if you're fading their recent success, that would be a bearish play for sure.
The guy who founded FedEx died over the weekend, Fred Smith.
Yeah.
He has one of the more interesting stories for how he saved the company. Back in the early 1980s or late 1970s, I don't know the exact date, but Fred Smith goes out for a pitch to General Dynamics, and he doesn't get an investment for them. And so they have the company has a $24,000 fuel bill due over the next week, and the company only has $5,000 in the bank account. So what does he do? what any good risk taker would do. He went to a casino. He bet the last $5,000 on blackjack, and he turned it into $27,000. So he's able to cover FedEx's fuel bills. And because he was able to cover the fuel bills, he was able to get a line of credit from investor, and he kept the company alive. So FedEx has a really interesting founding, right? I mean, literally, sliding door moment in history. You know,
It is wild.
He doesn't do it, right? And that's why the company is where it is today. True story. Encourage people to look it up. So, Mike, it's a 56.9 IVR. It's higher than Micron. Micron obviously is a name that's in the AI space. What say you about this? This recovery off the lows is obviously not as well. It hasn't covered the pre-Liberation Day gap, which I suppose thematically makes sense. It's a shipping company. What do you like about this stock right here? Would you play for just directionally neutral? Stay within an inside move?
I wish I could give you a math-based answer, but over the last 2 years, I've traded FedEx exclusively to the upside with diagonal spreads. And I believe in 2023, it was like one of my most profitable underlyings, which is hilarious. But I think the nice thing about FedEx is that even though IV rank is above 50, the actual implied volatility of August or even July is sub 50. So you can buy Delta here pretty cheap relative to the stock price. Micron has a higher raw implied volatility at like 60%, 55%, over 100% for this week specifically. But yeah, I think for me, I'm probably going to play a diagonal spread in FedEx. You can do a long August, short the weekly for less than $1,000. And Nike, I want to play to the upside, but I don't see how they can get out of this without knowing the actual tariff implications and how they can swerve around it. And Micron, it's crazy to say, but like I feel better about a Micron bullish stance even after its stock price has doubled, just because they're doing a lot to put themselves in a good spot down the road. So we'll see. I read the commentary from Nike executives in the last earnings call, and instead of talking about like what they're going to do going forward, it was just like, we're doing stuff in sports. People that are wearing Nike products are doing big things in sports. It's like, oh man, I've never heard a more not bullish thing said by an executive. So
they fumbled the bag so bad during the pandemic. Okay, and this is really where Nike's problems start. During the pandemic, when people started shopping online, Nike made the decision that they could pull their shoes off a certain retailer's shelves, thinking that the shift to online was permanent. And so they had their own digital store. And like you go to like a Dick's Sporting Goods or, are there any other big brand stores now that are for sports? Probably not.
I mean, Foot Locker.
They were just purchased. Either way, I digress. The point being there is that you go to a place that sells shoes, and Nike usually has a big stand inside the store, right? They have a big presence, even if it's a Target. That's not the case anymore. And so they let all these competitors get the shelf space, and then people started going back to the stores, and Nike didn't have the ability to get back on the shelves because the spots were taken. So it's been years of mismanagement on the marketing side. You can really see this play out. We go to a weekly chart. It's not just the tariffs. This has been going on from before the tariffs, right? 2022. They really never recover back to where they were pre-pandemic. It's because they made a really bad blunder with called arrogance, thinking that people just love the brand so much that they wouldn't have to sell their stuff in stores. It's like Apple stopped selling AirPods at, Best Buy. They'd just be dumb. Dumb.
It is wild to think though, like when you look at people wearing Nike, like professional athletes, you're like, ooh, that's a premium contract still. So at least they can fall back on that, but that only lasts so long. So we'll see. Theta Trader in the YouTube chat says that they think that they made a Silicon Valley episode based on the FedEx gambling thing, which I need to go rewatch that because Silicon Valley is one of the better shows ever made.
That's probably what the best show that captures the mood of the 2010s.
Oh yeah, so good
from a comedy perspective. I mean, Air Jordan is a Nike line, of course. LeBron's Nike. Durant is Nike.
Scottie Scheffler.
Yeah.
StockX exists because of Grail Nikes.
Oh, okay. And Caitlin Clark, which is the most important one of that list. Yeah.
Yeah.
Well,
Everyone.
who cares? They have Caitlin Clark and the stock's doing this. Are you kidding?
Come
That
on.
makes no sense to me.
That's not encouraging at all, actually.
No, that's not encouraging whatsoever.
That's not
Right.
encouraging at all. That the markets don't want to give him any kudos, even for that level of forward thinking.
What is encouraging though is Sophie Cunningham finally coming after Caitlin Clark's opposition. That was great. If you saw that video clip.
I have not seen that clip.
Oh, you got to watch it.
I'm surprised that's not like that's not. Was there a bet on that? Is that how you're aware of it?
No, it's just like Caitlin Clark is just getting.
That's how my dad and brother bring up WNBA stuff up to me. They're like, oh, did you see this? I'm like, okay, but why were you watching? Like, oh, well, I was the Pick'em streak on ESPN.
Well, these women in the WNBA just go after Caitlin Clark, like they're trying to actually injure her, and now one of her teammates.
Oh, the fouling's outrageous.
Yeah, one of her teammates, though, Sophie Cunningham, ripped this girl to the ground and was trying to pull her hair out. So it was good in defense of Caitlin Clark.
Some team spirit finally.
Yeah, but in other news, I actually have
checked out there. Crazy.
I have a question for you guys about interest rates. Believe it or not. So
let's go there.
I feel like every time I come onto the show, I'm looking at this chart, and I think this is the first time where I actually see some movement in next month's decision. If I remember correctly, I believe it was 85 to 90% chance that we stay at the current rate, but now I'm seeing a 22% chance we get a 25 basis point cut. What do you think about this?
This is one of the most interesting things coming out of the Fed meeting last week, which was exactly as pretty much anybody would have it, except for one little tidbit. The Fed actually reduced the amount of rate cuts in their forecasting for 2026. And so their net over this year and next went from 100 basis points to 75. And the market said, you're out of your mind nonsense, and moved the other way. And so you now have the cumulative rate cut tally for the markets at 120 basis points. So the market said, no, you'll be more dovish, and the Fed said, no, we'll be more hawkish. There's now a big disparity here, and somebody's going to be wrong. Powell begins his 2 days of testimony for Congress for the semi-annual summer episode tomorrow. So interesting stuff here. You do see that Fed funds futures are tilted more dovish, and that's how you get these odds up for July a little bit. But the Fed is saying the exact opposite thing, which makes this a little bit of a powder keg, maybe.
Trump just said here that he wants to thank Iran for giving us early notice, which made it possible for no lives to be lost and no anybody to be injured. Perhaps Iran can now proceed to peace and harmony in the region, and I will enthusiastically encourage Israel to do the same. Oil prices now down 8.95% on the session. It is it's a remarkable melt-off that's still going. We were coming into the top of the show, 4:00 Eastern time, 67.78. So we've basically lost another percent, just under that, since the show started.
Mm-hmm.
Yeah,
Mike. So maybe Mike, you could talk about this for a second here, because I know I've gone on about this a bit, and so is Ilya. So perhaps a different perspective or a different voice for the same topic, but as traders who are trying to stay mechanical, right? All of us are attached to our phone. We're all using social media. If you're using social media, if you're looking at any business news, these headlines are hard to avoid, right? How do you yourself ensure that you're not allowing yourself to get too emotional when you see these things? And that's not because you're like, oh my God, I can't believe bombs are flying, but how do you make sure that you don't overreact and continue to operate within yourself when you have days like today with these dramatic moves?
It's a great question. I think first and foremost, it's trade size. So if I'm trading, if we're going back to oil specifically, if I'm trading oil from a static delta standpoint where I'm just buying a contract, it's in the micro crude contract and it's only one. So like if I owned a micro crude contract, which I actually did through the initial tariff stuff, so I held a contract from when it went from 70 to sub 60. I was long at 66, I believe. So into the initial sell off there, I had bought the contract and I just held it all the way through. So if I had multiple contracts, that would have been a disaster for me. But because there was only one, I was able to hold through all the way, roll to the next contract, do some spread, do a call against it, sell a spread against it in the main contract, and I got out of it for a small profit, I believe. But now, after the big pop in implied volatility, I shifted towards more of a neutral strategy in the major crude contract, CL, but I did a 1 point wide iron condor. So again, keeping risk small, even through the move today and the last couple of days, it breached the upside strikes all the way up to 78 at the high. But it's a definder's trade. I know exactly how much I can lose. So it really just removes the emotion completely. Like the smaller you trade, the less I'm paying attention to my phone, the less emotional I am. And really that's when you can be mechanical, because you're not making decisions based on your pain or glory of a big move, either against you or for you. You're making decisions based on what you see. So really that's it. I think it's just trading small enough to where you are not having emotional reactions to any move.
Mm-hmm.
Not having emotional reactions to any move it's difficult, right? And I know a lot of people go through this, and you see things, right? You see it on Zero Hedge, you see it on MSNBC, and I point those two out because there's a lot of emotional content on there in political terms that activates that little monkey part of everyone's brain that the Strait of Hormuz is going to be closed and World War III is happening, and Ted Cruz, a U.S. senator, doesn't even know the population of Iran these days. So
holy moly, guacamole.
Right. But the point is that you have to operate within the system that works for you. And so sticking to the system of staying small, willingly cut losses, recenter your strikes if you have to. Who cares if you're right about any particular trade? The goal is to make money. So if it means you move something sooner and you avoid losing money, that's just as good as being right. Okay. And again, the point here is not to get taken out of the cart. So for those that were short oil now, this is the question, Ilya. If you were riding this out, okay, what do you do here? Because we started to break below some key technical levels. 68 was like the conflict line in the sand, if you will. We're creeping below there. Do you take profits here? If you're short a call spread, do you bring your strikes closer in? Do you just slap on an iron condor here, short iron condor, and go home? Because hell, we can go out to say like 53 days here still. The expected move is down to 52 up to 83. We didn't get through 83 last night. What is that free money?
So when I was putting on my short call vertical just a few hours ago, I did go out 53 days, because one of the things that I've been doing to manage risk, in addition to keeping size small, is putting more duration in than you might expect, which kind of dilutes your exposure to the directional underlying and gives you a little bit more room. And that's been very helpful for staying power, for not getting caught up in craziness, and for riding things out. So that's exactly what I did. I gave myself more duration. I used MCL rather than the full CL contract, and so kept size small. And of course, used a vertical and not an outright position to keep my risk capped. I don't think there's any reason to think that this move is over. There's still a good amount of IV here to squeeze out, and Asia and Europe haven't even tried to price this in yet. Those markets aren't even open as we get all of these headlines. So even for the next 24 hours, you might have legs. You might keep going here. There might be people here that are stuck long crude that are going to sell it and that are going to reposition as Asia comes online, as Europe comes online. So at this point, I think this thing might have legs. And also, the story in crude is generally, in my mind, bearish. And that's why the markets are screaming at the Fed that it needs to cut rates. The Fed isn't saying they're not cutting because the economy is great. They're saying they're not cutting because the economy is fine for them to ride out tariff uncertainty. And they're going to wait for the economy to become not fine in order for that to change, which is why they keep revising down GDP forecasts. It's not like they don't think the issue is there. They're not lowering GDP forecasts because they think the economy is robust and so they shouldn't cut. They're telling us they want to cut. So the story here for crude is of diminishing demand and of a global economy that's slowing. In fact, that's been slowing since the middle of last year. Slowly, gradually, but slowing. So if the geopolitics overhang is out of this is a short. And this is a short not just because of what happened today. It's a short because of what the underlying narrative is once you take the geopolitical situation out of your consideration and say, well, what's the actual supply-demand story here? It isn't great.
No, I mean, listen, we go back to a world where OPEC is ramping up production hikes. Interesting. Trump goes to the Middle East. OPEC Plus, led by Saudi Arabia, ramps up production before Iranian oil is taken off the market. Anyway, Trump's calling here for world peace. Congrats, world. It's time for peace for 2 p.m. So we at least have,
Sure looks like a mission accomplished banner. Just saying.
Well, I mean, narratively speaking, Mike, right? If Iran is telling us that they've responded proportionately and Trump is saying it's time for peace, then whoever fires the next missile or bomb is the bad guy here because this particular chapter's closed. So no escalation, I suppose, the next few days. Mike, we look at sectors here on overtime to take a look at how the stock market shakes out over the course of the session. The NASDAQ here, as we look to today's close, and there's still about 27 minutes left in trading. We are talking about a market that's up 1.03% here. Top performers today, the construction, the rate-sensitive items, home construction, home builders, telecoms, banks. Consumer discretionary is higher by 1.98% as well. Losers on the downside are all the energy names, OIH, XOP, XLE. So broadly speaking, risk on and quite firm. Like we were talking at the end of last call here about when stocks make a move back to all-time highs. Are semiconductors coiling for that move here as we get ready for the month of July?
I love that term, coiling. It seems they're well on their way, right? I mean, AMD, Micron, NVIDIA, all similar charts to the upside, all up like 50% or more in the last couple of months. But there's one thing I remember saying when we had the tariff implication stuff going on and we were in backwardation in volatility futures. I was saying, you're not going to get back to all-time highs unless you come out of backwardation. And although we are right now, it's barely there. We're still pretty flat. We were actually in more of a contango a couple of weeks ago, of course. But yeah, I mean, if we steepen that contango a little bit and volatility goes from the 20s to, let's say, 17, 18, I think you will see a climb higher, no doubt. When that happens is tough to say, but I mean we're not too far off of all-time highs. So if we're trying to get to like 6,500, 6,600, I would say a home run there would be like the end of the year. But I think we could create new all-time highs pretty soon here if we continue on this path and there is actually de-escalation and volatility gets crushed a little bit. Would not be surprised whatsoever to see that happen.
Volatility was crushed a little bit here. Back under 20 on the VIX. It's not exactly free and clear. We pop up. We have the close on June 12th at 1743. Right, we gap open higher at 2176 on Friday, June 13th. So we haven't necessarily taken the vol out of the market since this Israel attack against Iran, but it's getting back down towards this particular episode's lows. Elliott tomorrow, Fed Chair Powell might have a chance to help nudge things along. The Fed Chair didn't really mention Israel-Iran last week, right? Kind of hinted at it, but not directly, and that's not atypical. He didn't mention Israel-Iran in May or November of 2024, a month removed from those strikes and attacks. Mm-hmm. What does Powell say tomorrow? Now that we're getting away from the U.S.-Iran portion of the story, what does the market think of Powell's testimony tomorrow?
Well, I think it actually starts to matter because the geopolitics apparently is off the table and because stocks haven't gone anywhere basically since we got the last U.S. CPI data, and neither has the dollar. And that CPI data was relatively soft. The PPI data the next day didn't tell you that it was a mirage the way it was in April because businesses ate all of the tariff costs and didn't pass it on to consumers. So it looked legitimately like there's a cap on inflation. And if you look at break-even rates, they're down. They've been going down. They popped a little bit on this Iran story, but that's because crude oil popped, and we know that's not here to stay. Just look at it. And so aside from the geopolitical spook, which, by the way, didn't even take break-even rates out of their range, they've been down since Liberation Day in a consolidation. Stocks have veered off. They've been the odd one out after both break-evens and stocks fell amid the growth scare from late February, mid-February to early April. So the markets are telling the Fed, you've got a growth issue. You don't need to be sitting on the fence. You need to be cutting. And they're pricing in more cuts, not less, from the meeting last week into now, almost by an extra cut. So that exchange rate that we had last year in cuts now versus cuts later, the Fed says one fewer cuts now, and the market goes, right, so two more cuts later. That's what the pricing is showing us now. So we're looking at a situation where if Powell convinces them, if Powell comes out and forcefully convinces the markets that, in fact, he's not kidding, they're not cutting, the bias is to let the economy break first because they don't know what they need to do, then you probably get a higher move in the bonds at the long end as people push more cuts downwind. You probably get a stronger dollar as it looks like it's going to maintain its yield advantage against the major currencies. And then you might really get a nudge lower in gold that there's something to believe. I mean, I'm still long. It's got to show it, but it could be vulnerable here because, like the dollar, that's a crowded sort of trade on the opposite side of maybe a Fed that's saying, listen, you're not going to convince us. There's no issue here. It's coming later than you thought. And then we're going to spend all summer going back and forth on it.
Yeah, actually, we're getting quietly rate cut odds for next year are creeping up to a point where, a little bit more, and you're talking about the main rate being closer to 3% by the end of next year and being at the end of 3% next year.
It's on the move.
Yeah, it's certainly not the situation we were looking at quietly. It's not a 2025
Very quietly.
Story. It's a 2026 story. The market's saying that once Powell's gone, Trump's appointee will give him the goods. We'll give him what he's looking for. He wants lower rates. He's going to get these lower rates, but it's not this year. And the market's kind of comfortable with that. It's not a problem for stocks. It means nothing bad's happened, right? Nothing bad's happened if the Fed doesn't need to give us emergency cuts.
So far, no. But also, again, they're not rallying. And this is the most interesting thing about it. You get that CPI number and everything stops. They're not rallying. The dollar isn't falling, and they're not rallying. And it happens simultaneously. Both moves hit a wall. So, and not even a war in the Middle East gets them out of bed. They're like, nah, you're going to have to tell us something different.
What do we make of the dollar here, though? Because last week I was bandying on about how sentiment was stretched and it was looking good so far. Today it was looking great earlier. But the dollar comes back in pretty heavily, and just like you see in several different assets today, you get an engulfing candle. Technically speaking, we set a new high relative to Friday. We're closing below Friday's low, and this is getting us pinned against our 1 month moving average. Ilya, I'm riding this out so far.
I'm long.
You're still long the dollar.
No, I flipped long on Friday, and I've been getting more long since. I think this looks like a bottom, not a structural bottom. I think the trend for the dollar is probably down for a period of years at this point. But you look like maybe the move since the beginning of the year has run aground. And if anything, this looks more like a head and shoulders that wants to form. Because the same range that you see in stocks, the same kind of sideways drift, the same refusal to pay attention to much of anything since that CPI report, that's what you're seeing in the dollar. You're seeing swings inside that range when the geopolitics demands it, but you don't see, if the dollar was responsive to geopolitics the way it would be, it would look more like crude oil. Like those swings. That's not what you see. Not in here, not in gold, not in stocks. Why? All of these are intimately Fed sensitive things. And they reacted like this war didn't even happen for the most part. It was crude oil all by itself.
Speaking of crude, at what point is crude a buy? From Peter in the chat. Is it as easy as sub 60?
It's a great question.
62. 64. Right. If we're going to give this a chance, why not back to this swing low from March where the highs were in April and May? Yeah. Right. We're going to completely squeeze the latest bit of tension out of the market. Oil started jumping up before.
Narrowly, yeah. That range top was what, 62 and change? Call it 62.50.
If I'm short oil because of what's happening here, I'm probably looking at 62 to 64 as a place where I would take any short exposure off. That's my plan, at least. And then at that point, maybe flipping long. But Mike, I still think one of the more appealing things out here, if you go to 53 days, again, 54, 52. Let's get rid of you here, actually, because that had a full futures contract in there. 54, 52 on the short put spread side, and we'll call it 82, 84. So that's still six. Oh, gosh, that's really come in over the course of the day. That's not a great risk to reward, risking 5.5, 5.6 to make one. I don't know about that. But if you play with the pop and you're willing to give up a little bit more and you pull this in, you could still get something in that neighborhood of 3-1, 4-1. Directionally neutral may be the best bet. You're just betting that we're not going to clear out oil's highs that we had at the start of this week. Is that an unreasonable thing to do when we're placing a trade here? We're not going to punch through today's highs. I don't know. If the market's going to give us that trade, we got to take it. How could we not?
Yeah. And honestly, a couple days ago when OXY/CGI was popping off, and that is not the right ticker symbol. I forget what it is. But oil.
What company?
Just oil volatility.
Isn't that OVX?
OVX.
I think it's OVX.
OVX:CGI. It popped off. It reached a peak-ish on June 17th. So at that point in time, if you're playing neutral, even if you were looking at micro crude or the larger crude contract, like you were able to get way out on the curve because the implied volatility was there. It's come down quite a bit, but yeah, I mean, the neutral range is still pretty wide. Like you can still go above 80 or 75, somewhere around there if you're trying to create a neutral iron condor. But yeah, for me, like the micro crude contracts that I've been trading, where I'm just buying the micro crude contract, I was doing that anytime we went below 70 earlier this year. Now I feel like with this kind of range, I agree with you guys. I think maybe 64, 62, or if we get below 60, that's like an auto smash for me. One contract though, because I can absorb any variance that goes my way. So yeah, if we see a bigger liquidation here where we get down to 64, 62 pretty quickly, I'd be happy to take that risk for one micro contract.
Maybe just to chew on this for a second here, I couldn't help but notice, just looking back at the chart, when we have the Russian invasion of Ukraine in February 22, we have about a month or so where oil vol stays up. But even so, prior to the pre-invasion machinations getting into play, Russia started moving troops into the area in November of 21. You didn't see oil vol come off the board substantially, right? It stuck higher, basically right around 50 for several months. If oil vol is just kind of pinned here, let's say the IVRs for crude stick around 50 or 60, Mike. Not that I'm saying they will, but let's just say because of this now risk that's going to be sitting at the margins, oil vol can't deflate back to a 20 IVR. What kind of trading strategies would you employ for the market to move around and chop around sideways without vol leaving? How do you capitalize on that kind of situation?
Well, I think you could still do iron condors for sure, because you're really, especially with narrow iron condors with the bigger crude contract, it's really like a set it and forget it type trade where you're setting it at the current IV, and instead of waiting for IV to collapse, you're just waiting for time to come out and decay the extrinsic value. Where a micro crude strangle is another way to do that, where you'll get a faster decay there, but maybe you don't get, the IV collapse you're talking about. But when we have these heightened implied volatilities, I think it shows up most in like calendar spreads, because if you look at the crude contract and you look at like the U contract, for example, if you look at the difference in days here, so you can see the 25-day, the July 18th contract for the U contract has a plus minus $6 expected move. If you look at the 53-day August 15th contract, it's got a $7.95 expected move. So more than twice the amount of time, but essentially the same expected move. So like that's another way you can play it, where you're buying the 53-day and you're selling the 25-day, but you're making sure that they're both settling to the same contract, so you're not calendarizing your options. You're in the same options contract in the U settlement contract, but you're still able to stagger those days. So, and that one's nice because you can take that calendar spread, take that idea, and you can still shift it directionally. Like you can do a call calendar out of the money or a put calendar out of the money, and kind of play it both ways.
Ilya, what are the implications for the broader market if oil stays here? When do we stop talking about, I hate to say that we're going to stop talking about this, but it feels like this is an event that is going to remain in the news. But from a trading perspective, what do we do with it?
From a trading perspective, it might be over already. And then you go back to your regularly scheduled programming. You go back to crude oil being a function of demand, and that demand being a function of global growth. And there you come back to a very familiar conversation. Nobody was paying attention to this, of course, today, but S&P Global published their updated PMI numbers for June. And it's a very familiar story. Looks just like last year. Japan basically standstill. Eurozone, standstill actually. UK, standstill. The US, again, the only game in town. And again, because of the service sector. So you have a situation here increasingly where you're coming back to last year's playbook. Only global growth overall is now slower. It just started last year. And you can see that basically all of last year, you had the US outperforming, and everywhere else, all the other growth engines that matter, the Eurozone and China mainly, with the US, the three of them are 58% of global GDP. And that's before you count that all the other economies, the other 42%, are for the most part vendors and need the other three to grow so they can export into that demand. Otherwise, they don't have economies as such. And so you have a situation here where this just takes you back to, oh, global growth is near 17-month lows. Oh, there's a single point of failure. That point of failure is the US. If that fails, there is no safety net. Oh, US economic data has increasingly disappointed relative to forecasts over the past several weeks. The bond markets are not buying what the Fed is selling. And if you look at the Atlanta Fed's GDP tracker here, it's high level wise because of the arithmetic from the first quarter's tariff aberration, let's call it. But look at the direction of the model's move since you got a second quarter GDP now model. Where have we been going over the past several weeks? It's down. And it's telling you that the incoming data into the model is fading, right alongside what the Citigroup Economic Surprise Index data is telling you. U.S. data is fading. So if you have one point of failure and the direction of travel is not good in that one point of failure, how good is the outlook for a cyclical commodity? Not great. So I'm pretty happy staying short here. We probably have a little bit more legs on this yet.
Yeah, U.S. City Economic Surprise Index is at its lowest levels of the year. That doesn't really mean anything in isolation, and we actually haven't talked about it in a while. So for those that...
No, it's context.
Right, so it's a time decay function that basically gives you a weighted mean of whether or not data is beating or missing expectations. And so the more negative the index, the worse the data is coming into expectations. And when the index is rising, it basically means that things are getting better. And because it's a time decay function, newer data carries more weight than older data. So something released today will carry more weight than something released 2 weeks ago for the input. And so when you see something like the City Economic Surprise Index falling to new lows, even after today's data, we missed expectations, but those expectations are already coming in. That's the point. And we still managed to miss expectations that were downgraded. So data isn't exactly positive. But if data aren't positive,
this thing is scaled by volatility in the FX market's response. So if the data misses and that moves markets, and we saw it didn't move markets today because markets were looking elsewhere, then it looks bigger. So you might consider if there wasn't a big Iran headline today or over the past several days, the surprise index would be even lower.
I'd like to point out that the surprise index is sitting at levels near where it was last summer when the Fed ultimately made its decision that they should cut rates by 50 basis points. Okay, so we're not, these calls for July cuts aren't exactly coming out of thin air.
No, the markets are clearly trying to goad the Fed into something here and tell them, listen, you were wrong last time when we talked you into it, or at least from our perspective, you were wrong. I've argued maybe the Fed is doing something akin to judo, where they let the markets work themselves up in a direction, and then instead of pushing back, they pull in and then throw the markets off balance. Because the moment, of course, that they cut 50 basis points last year, what do the markets do? They go, oh, no, too dovish. And the Fed is ultimately much better at quelling evacuation than if they tried to resist. So we'll see how this goes. But if that's the maneuver, if it's judo that the Fed is doing, then markets might be sniffing out that September they'll go big again after all of this resisting and protesting now.
Mike, we only got a few minutes left here. I'm still gawking at the fact that oil was up near 78 earlier and it's now closing just below 67.35. What's your number one? What's the number one thing you're looking out for this week? What do you care about most?
I think we still focus on oil. I liked Ilya's call out earlier about how really only our markets are involved right now. I think when other markets open up, maybe we see some continued movement. Implied volatility is still high there. But I mean, if things are de-escalating, escalating, whatever, like oil is still going to be the first thing that moves, I would assume. So definitely going to keep my eye on oil. I'm going to keep my eye on it and see if we get closer to that 60 level, in which case I'll be buying a micro contract. I would rather be long oil than short oil, even if we get back up to the mid 70s personally. And outside of that, I'm going to just focus on these earnings trades and see what else the market brings. But I really, like in these environments, like today's a weird move. This market's kind of weird today. But in these environments where there is global uncertainty, I like to just take risk off where I can. So like the Ion Q short put, took that off earlier. DraftKings Strangle I've been managing, took that off earlier. Both were small wins, but I'd rather just have risk off in case something crazy happens, then I'm not stuck in positions and I have the ability to layer on new opportunities. So that's where my mind's at.
Ilya, you have any strong feelings about stocks? I think that answer precedes itself. What do you feel about broader market sentiment up here, though? Is there a wall of worry for us to climb, or have bulls shot their shot at this point in time?
If you can't break the range, having avoided a war that you weren't spooked by to begin with, it's very clear to me that you should not take this de-escalation with Iran as a reason to be long stocks. There are reasons to be long stocks, clearly, but that doesn't seem like it. And so I'm focused on the Fed, and to me, this looks like something that is vulnerable to rolling over still. I'm glad I have a lot of duration in it still. I'm glad that they're verticals still, because this is a market I'm plainly fighting. But I think the risk reward here still looks much better being short under the recent high. If you're wrong fast. If you're right, you have lots of room. I also like the flip side of the US dollar, which looks very similar to this. And there, I'm a lot more aggressive. I'm short euro. I'm short the pound. It looks like it's rounding out a bottom, much like stocks look like they're rounding out a top. And I think this is probably where we start a readjustment. If the war is off the table, and all we have to go on is Powell fighting the markets on rate cuts this week, this might be where this whole thing turns. My gold position probably won't like it though, so I'm gonna have to look at how the diminishing evolve from the non-war and the disappointing for gold Fed shake out in the end.
Before we close up here, I just want to complain a little bit. It's almost 5 p.m. here in New York, late afternoon. Why on earth does it feel like 110 degrees outside?
Because the Mets are hot, baby.
Okay, the Mets are 1-8. The Mets are 1-8 since Israel bombed Iran. Okay, all right.
Honestly, that Philly game, I was watching it and I was like, "Ooh, Lindor homer. Vecchio's gonna like that." And then Nimmo, second homer of the day, he's gonna like that. And then Soto, three back-to-back homers. I mean, come on. He must have been just cheering.
You saw what I tweeted, right? Because that happened a little after the news that we attacked Iran was announced. I said Mets dropped 3 bombs on Philadelphia.
Oh my God. They did.
Oh boy.
They did. That was a good one.
And that's all, folks.
Yeah.
Overtime's out of time for today. We'll be back tomorrow, same time, same place, every Monday through Thursday, 4 p.m. Eastern, 3 Central, right here on Tasty Live. So for Mike Butler in studio in Chicago, Ilya Spivak in San Francisco, I've been Chris Vecchio in New York. Good luck trading. Ilya is going to take a brief break. Then he's back for more Tasty Live macro money coming up next. See you there, folks.
See you there, everybody.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that 1-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
The future of trading is here. Join Mike and his whiteboard, plus the Tasty 2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
My dad, who was trading options in retirement, introduced me to options trading. He said, you have to check out this Tasty Live site. The way they taught options was very accessible and easy to pick up. I think a lot of people think that options trading is gambling, but it's not. It is simply probability and taking an educated guess. It's more like insurance. People should watch Tasty Live because you can pick up a lot of information in a short amount of time, and it's actually practical. You can use it to make money, most important part.
Calling all traders. Are you using Tasty Live mechanics and enjoying awesome results? Are you an up-and-coming options savant? We're looking for you. For over a decade, Tasty Live has shared the most inspiring stories of traders teaching themselves a new skill, using probabilities and experiencing new levels of success. If you think your trading journey should be shared with Tasty Nation, we'd love to hear from you. We are always on the lookout for the next class of rising stars. Email us at risingstars@tastylive.com if you'd like a chance to share your trading journey and inspire others.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
Class is in session. Dr. Jim Schultz is bringing the heat to Options Crash Course Live. This 90-minute show features Dr. Jim in his professional prime. All of the gimmies, none of the gotchas. Come early and grab a drink with Dr. Jim before class and stay for Q&A. The event is free, but space is limited. Register today at tastylive.com/events. It's not a lecture, it's a lifestyle.
So why are we all doing all the things that we do inside of the active trading space? Simple. To make money and generate returns. Well, inside of the Tasty universe, there are essentially 5 keys to making those returns. And in this crash course, we're going to break down all the details of each one of those keys. So I'll see you inside.
The U.S. enters the war with Iran, and then not. Have an interesting start to the week here. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live, and boy, do we have a lot of volatility, but stuck only in one asset today. All of it surprising, not only because the volatility has been so sharp in crude oil, but also because nowhere else seemed to care very much about imminent war with U.S. involvement in the Middle East. So what in the world is going to move these markets now? That's what we're going to try to tackle here as we look at, surprise, surprise, the Federal Reserve once again, because as though last week's policy announcement were not enough, now we have the semi-annual testimony from Fed Chair Jerome Powell to contend with. I'm going to break down how the markets are setting up here and what all of this might mean as that testimony kicks off tomorrow. So let's start first with what the markets did last week, because it really is something to behold. Look at the 13% jump in crude oil, and you might think, oh, well, surely there is a terrible conflagration afoot. Israel has struck nuclear sites in Iran. The U.S. has mulled at the time entering the conflict directly. This is now, of course, a snapshot before the U.S. ultimately does strike Iran itself. But last week, clearly, there was enough of an escalation here, and things remained relatively steady the following week as we sort of got tit-for-tat results. But if we take a look at what this has meant across broader assets, notice it's relatively tame. You don't get a big response from the U.S. dollar over these past 2 weeks. It's a little bit higher last week, perhaps on some degree of haven support, but considering the yen has been basically oscillating, it doesn't really look like that's the case. The yen also typically finds a degree of haven support in these kinds of situations, and clearly that's not what we're seeing here. Gold found a bit of support initially 2 weeks ago, but hasn't really made headway. We don't exactly have a story of runaway inflation expectations around all of this, because we can see bond yields here. They continued to fall last week after falling in the previous week. So we don't exactly have a story here to paint around. This surge in crude oil is going to be something that is going to negatively impact rates with higher inflation. And stocks really ultimately don't do very much. They're a little bit lower as all of this breaks out. They're a little bit higher last week, but ultimately nothing goes very far. And what's interesting as we get very rapid de-escalation today, after the U.S. strike over the weekend, we find much the same story. It's crude oil, mostly all by itself. There's a dramatic decline here, clearly. And after this snapshot was taken, we seem to have recovered a little bit of lost ground. So we're closing down closer to 8%, and not quite as close to 9%. But nevertheless, the decline is eye-watering. This is the biggest decline in crude oil since September of 2022 on a one-day basis. Stocks a little bit higher, but they don't run away. Bonds a little bit higher as yields come in, but again, nothing crazy. Gold steady. The euro a little bit higher as the dollar finds a little bit of a responsiveness to improving geopolitics and sheds a little bit of whatever haven support crept in. And the yen is basically steady, as is Bitcoin, a sort of benchmark for high beta, high volatility, high risk sensitivity type of assets. And so you're looking at a situation then here where the market seemed to shrug off this entire episode. And perhaps it is because you don't really have the makings for World War III here, since the asymmetry conventional forces-wise between the U.S. and Iran is overwhelming in favor of the U.S., of course. And also because Iran's non-traditional, sort of asymmetric capacity outside of conventional warfare has been systematically degraded over the past year, with Israel having basically run over both Hamas and Hezbollah. And so maybe whatever this was going to be was never taken very seriously by the markets, at least as far as an immediate risk to the kind of disruption that would actually impact global macro realities like global growth and global recession risk. And so it kind of stayed within crude oil for the most part and didn't really go elsewhere. Certainly the squawking today suggests that both Tehran and Washington are not in the mood to escalate. Tehran struck some U.S. assets in the Middle East, but telegraphed the move, warned ahead of time, and didn't cause any serious damage. For its part, Washington signaled that it's not looking to escalate further, that it's not going to retaliate to these strikes, and now is the time for peace. So it looks like the entire conflagration here has, from an immediate market impact perspective, come and gone. Now, that doesn't mean that the geopolitics of the situation have meaningfully improved. Israel and Iran will almost certainly continue to clash, and we're almost certainly going to get some amount of reconstituting and response out of Iran, assuming, of course, that the news doesn't bring some sort of change in the political reality there. But that increasingly looks like a story of years. And so in that sense, the implications for the markets now and for the macro narrative now are understandably muted. And the price of crude oil seems to reflect that. All of which takes our attention back, surprise, surprise, to the Federal Reserve. So last week we had their policy announcement, and this week Jay Powell will try to explain it. First in the House of Representatives, next in the Senate. The speeches are going to be, for the most part, exactly the same. But then, of course, there's going to be a Q&A session after each one, and that, of course, will be unique to the lawmakers present there. So different things might come out. Both days are worth watching. when the Fed issued its policy announcement last week, we see that what they said was relatively predictable, that the unemployment rate remains low, that labor market conditions remain solid, and that inflation is only somewhat elevated. But more importantly, that uncertainty about the economic outlook, though it too is still elevated, has diminished. Now, this seems relatively straightforward from looking at just what we already know in business and consumer confidence surveys. We just had an update of S&P Global PMI numbers here earlier today. Not that anybody would notice because of all the Iran news, but what we have here is a U.S. economy that's increasingly finding a cadence and steadying. Very little change here between what happened in May's surveys and in this June update. In fact, what we see here is the U.S. economy sort of stabilizing at modest growth. Of course, as ever, PMI numbers operate where 50 is neutral, above 50 is expansion, below 50 is contraction. The further you go above 50, the faster the expansion. The further you go below 50, the faster the contraction. Here we're clearly above 50 in expansion mode, and over the past several months we've come off from standstill right around here. That's March, give or take. And then we head back to a kind of neutral, it seems, within this range that we've been carving out since the beginning of the year. Now, of course, that's a meaningful step lower, meaningful level change lower from where we were in the second half of last year, but nevertheless, steady growth broadly continues. And then when we look at consumer confidence, we can see, of course, in the latest numbers, there's been a very meaningful recovery as one-year inflation expectations have come in from 6.6 down to still high, but in relative terms, much lower, 5.1%. So the Fed is certainly not off sides in saying the general consensus seems to be that things have calmed down some, even though they are not calm in absolute terms. Now, where things got really interesting was in the update of the forecasts, where relatively predictably, given what the Fed said in May, a further downgrade of growth expectations, a further upgrade of expectations on the employment rate, that is to say, weaker growth, weaker jobs market, and an upgrade on inflation. This, of course, makes sense. The last time that the Fed gave these forecasts was in March. And then in April, we had Liberation Day, followed shortly after by a 90-day pause. The Fed's entire argument since March has been, we don't know what the tariffs will do, but historically they are inflationary and bad for growth. So we're going to expect that there will be more inflation and less growth until we're shown otherwise. But with the economy in relatively decent shape, we don't need to do anything. The unemployment rate most recently, 4.2%. The inflation rate most recently, 2.4%. So we're in a pretty good space here. We don't need to do anything until the economy shows us otherwise. Now, of course, that was March, and in April, what the markets and the Fed have learned is that the uncertainty will be prolonged because, of course, now we have these 90-day pauses since early April. One expires in early July, the other in mid-August for China. And so when we look at all of that, well, the Fed just did more of the same. They said, well, the impact will be pushed out later, so even less growth and even more inflation and an even higher jobless rate. We're just going to move where that tariff impact bump was going to be forward in time. So far, so good. But what really struck and what really seemed to deviate here was in March, the Fed did not want to say what that might mean for rates. They just kept December's forecast for 50 basis points this year in cuts and 50 basis points next year intact. Didn't change anything, didn't say anything, and said, look, we don't know where this is going. we're going to fiddle with these forecasts, but as far as rates go, we'll let you know when we see which side of our mandate, the employment or the inflation, we need to be prioritizing. But this time, that changed. And it seemed like the Fed was pushing rate cuts off even further, because for next year, they kept this year at 50 basis points. For next year, from 4.4, that is, down to 3.9 median rate. For next year, they went from 3.4 to 3.6, saying now they only expect one cut next year. And this is where things get interesting, because the markets apparently do not believe them. If we look at what the markets have done, and this is despite the fact that they've not taken seriously, it would seem, any kind of an impact from the geopolitics in the Middle East here, is they've gone out to 120 plus basis points between this year and next. The full 50 that the Fed wants for this year, that's in the forecast. But for next year, the Fed only wants to do one cut, and the markets are increasingly starting to approach 3. As if to say, no, you're wrong. You're going to have to do more, not less next year. In fact, even just the move in the implied Fed curve since the meeting last week and into now is looking a little bit more dovish. Only a bit. But the markets are angling in the opposite direction from where the Fed is trying to lead them. We see this really since about mid-May, where if we look at what the bond market's expectations for inflation look like, these are so-called break-even rates, the difference between nominal and real interest rates, which extracts the inflation adjustment that you need to make to get from nominal to real. Real rates are nominal minus expected inflation. They've been pinned in this narrow range here since hitting a low in April. Now, of course, we can see stocks have rebounded and decoupled from them, having been moving lower with them around the growth scare linked with tariff implementation at the beginning of the year. But clearly sentiment there has improved, to the Fed's point. But inflation expectations have not. They're still pointing to some sort of growth downturn. And that speaks to what the markets are saying to the Fed here. So how Powell reacts and whether he convinces the markets or the markets ultimately just take the resistance to cut as evidence to keep pushing this further, that remains to be seen, of course, but the markets are not entirely off sides. Once again, we are back into a situation here where you can see the story is not unlike what we had last year. The U.S. has leveled down on growth, but just like the second half of last year, where the main drivers of global growth, and we've seen this chart many a time before, showing us that it's really just 3 economies powering global demand here. 58% of global GDP is the U.S., the Eurozone, and China. Of those 3 economies, the Eurozone is back to standstill, much as it was through the second half of last year. China is still at standstill, and we've put the latest numbers here in orange just because we don't have those numbers yet. This is standstill as of May. The June numbers for China due next week, and since there's not even official forecasts for them yet, we're just kind of assuming that they'll hold steady for the sake of argument. But we can see here, if they did as expected here, based on our very non-scientific forecast of 1 in the sample space, we'd be looking at something that's been the case for China really since the beginning of last year, which is to say sideways drift, hugging that 50 line, going nowhere. And while last year the U.S. was outperforming by a much larger margin, now it's still outperforming, just less so. And so what we have here is essentially a single point of failure for the global economy. If the U.S. falters, a global recession becomes basically inescapable. In fact, we saw all through last year as global growth slowed. These are global PMI numbers now, and we can see the composite edging down, showing us that the U.S. is a bit of an island on growth, that it's not spilling over, that it's staying in the U.S. while everything else is anemic. And that's how you get that deceleration. And that's, of course, not so great news when you see that looking at the Citigroup Economic Surprise Index, it is the U.S. where economic data flow seems to be the most adverse. Whereas for emerging markets, it's holding relatively steady. For the Eurozone, it's actually improving. And so when you look at the global total here, you can see that the reason it and the G10 index are drifting lower are surely not the improving Eurozone, it's the sinking US component. And so the markets are not wholly unreasonable here in saying the Fed needs to get a move on. If Powell then forcefully makes the case to policymakers that actually it is this that the Fed intends on doing, and it's because tariff uncertainty continues unchecked, and for as long as that uncertainty continues while the economy remains in semi-idling but not any kind of emergency mode, at least as far as growth and inflation are concerned, at least at the headline macro numbers, well, then you're in a situation where the Fed can continue to wait, and the risk that something breaks continues to extend further into the future. And if the Fed sells this point, and the markets ultimately say, well, we're going to have to adjust. This is not even coming in 2026. This might be coming later. Well, then that starts to look like perhaps gains for the long end of the Treasury bond curve, where yields might start coming in and the long bond, as well as the 10-year, might start to build higher as more cuts get pushed further out in time. The dollar might strengthen after a very rough start to the year, as it looks like it might have more of a yield advantage. But then what stocks and cyclical assets do is a bit of a black box, because if the markets think that the cuts are in fact needed and that the risk to growth is in fact acute, then the Fed's delay is not good news at all, because it is not delay because of economic strength. It is delay out of concern and uncertainty. That is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'll be back with Chris for Futures Power Hour on Friday as well this week. On with Victor Jones for The Price of Truth on Tuesday. Back with Victor and Tom for First Call on Sundays. Writing for the News and Insights portion of tastylive.com. Commenting at Ilias Pivac on the platform formerly known as Twitter and on Blue Sky. If you're watching this on YouTube, like and subscribe. Macro Money is back tomorrow. Good luck trading.
All right, we're back. Tasty Crypto Show. I'm Ryan Grayson. With me today, fellow Crypto Cave member, Dan Cecilia. Dan, what's going on, my friend?
Nothing much. Happy to be here. Market's taking a little bit of a breather. Crypto market specifically, I think.
Yeah, what the hell?
A bit of a breather, yeah. I don't know what's going on here. I thought we'd be at a 200K by now.
I was hoping the same. We're going to talk about that in just a second. We've got a performance dashboard. We'll talk expected moves, kind of go around the horn here, take a look at some headlines. We had a Fed day. I don't pay attention to much of any of that anymore. I think the probabilities were basically zero of any interest rate cut, at least for right now. I think there's still 2 cuts priced in. I suppose maybe I do kind of pay attention. 2 cuts priced in for the rest of the year. I didn't see anything, and my internet connection doesn't work over here either. So I don't know what's going on, man. Did you see anything? We had, what is there, some legislation passed, possibly? The chat's blowing up.
Genius Act passed. So
Okay.
stable coins are now, there's some regulatory framework for US dollar stable coins. So now all these kind of representatives, Sachs, Besant, they're saying that stable coins can reduce debt costs. Besant, I don't know, Scott Besant. Stable coins are a $3.7 trillion market opportunity by 2030, Scott Besant. And then Genius Act extends dollar dominance. So those are some quotes from representatives.
Well,
about
it's good when you have the U.S. Treasury Secretary or the Secretary of the Treasury. I don't know what the exact formal term is, but when he's pumping it.
Right.
That's
we
good.
want that. We want that.
Absolutely. Yeah, I'm excited about that. Look, we thought that, and I don't know if that's been signed yet or kind of what stage that's in, but passing in the Senate, is that right? Very, very close.
I got a ton of stuff on stable coins now. JP Morgan piloting stable coin on Coinbase's blockchain. They're going to call it JPMD. Let's see here. And then Coinbase or JD.com applying for stablecoin licenses globally.
Okay.
And then Coinbase is seeking approval for tokenized equities. So those are some news items, I guess, that.
Yeah, that's huge. I mean, look, you're going to see this everywhere in terms of financial institutions looking to participate. Clearly today we have some first movers, Tether, Circle with USDC. I'm sure the stock price is up as well on this news here.
Yeah, I mean,
Circle Internet Group straight up, Dan, $200 a share, just shy of it. And so, yeah, this is huge for the industry, right? It's going to pull in more liquidity, capital that's on the sideline. I think this is big for treasuries, real world assets, right? There's this narrative in the market where, people are concerned. Who's going to buy the debt? Who is going to buy all this issuance from the U.S. Treasury? The Japanese are dumping, my friends. The Chinese are dumping. Nobody wants this debt. I think when you look around the world, emerging and frontier markets, dollar-based assets, and if you make it a lot easier to access these assets via blockchain networks, via stable coins, which clearly stablecoin regulation here in the U.S. and presumably the global harmony that follows that regulation, that will bring a lot more liquidity and a lot more participation on chain in terms of treasury investors.
Yeah, for sure. I think that's why everyone's behind it, right? I think they know that. So have you looked at the stablecoin market cap dashboard?
The last I checked on DeFi Llama, which is a great source for this, and we can pull it up in just a second, but I believe that we had a total market cap of close to 250 billion. I think about 70% of that is probably Tether, though the market cap of USDC has recovered quite a bit post that 2023 peg when we had the whole regional banking crisis.
Right.
But I don't know exactly where we are. Let me try to pull that up here. Yeah, 251.686 billion USDT. That's Tether, 62% of the total market cap, or the Tether dominance there. So here's DeFi Llama. If anybody watching is new to this space and you're interested in monitoring some of these DeFi protocols, seeing what's happening on chain from a more fundamental perspective, this is a great source. Token Terminal, Dune Analytics. There's a lot of dashboards out there.
Yeah, for sure. How about Coinbase stock? Got some people in the chat asking about that. That was up 17% today.
Yeah, I don't have my Tasty Trade platform up here just yet. Let me get it on. Boom. I wasn't watching, haven't had a position in this. Presumably, this is on the heels of the positive news around stablecoin legislation. I think this opens the door to a broader crypto markets structure bill at some point. But yeah, I don't know. Have you seen anything else here around this massive move? They didn't have earnings or anything like that.
I don't think
this
so.
Was intraday.
This has got to be around the news of the tokenized equities.
Yeah, I did see that earlier today. Coinbase announced that you can use stablecoins as collateral for their futures. And when you think about Coinbase, a lot of times we look at this as possibly a brokerage sort of competitor, right? When you interact with it as a retail user, but this is an exchange,
right?
And hopefully at some point we'll be able to offer some of the products that are available on that exchange through the tastytrade platform. When I think about some of the perpetual futures that they've spun up or some of the other derivatives that they're offering, we don't have regulatory clarity in all areas, but Coinbase did just buy Deribit a month or so ago. So on the options front, there's some interesting developments as well. And assuming you get some regulation, that might open the door to a lot more participation on the exchange and a lot more that we might be able to do.
For sure. Yeah, definitely. I just Googled this quickly. I guess they launched stablecoin payments for Shopify. They partnered with Shopify.
Okay, I saw that on the Base Network the other day.
I guess like this news for this stablecoin act passing was the catalyst for this, I guess.
Well, and Coinbase has a huge partnership with Circle, as I think everyone's aware if you're following Circle or the IPO. USDC has been supported by Coinbase, and you can use that on the exchange. I use that at times myself. I don't want to make any big announcements just yet, but as we've talked about, and we were in New York just a couple of weeks ago at the StableCon conference, we're working on stablecoins in other parts of this market. It's readily available today. So to me, this is clearly the direction that things are going in. It's the future. It's instantaneous, 24/7 settlement. You look at the existing payment rails today, ACH wire, and I think arguably they're antiquated. You'll be able to eventually on a Saturday, you want to trade crypto, fund your account with stablecoin, you want to buy futures on the Sunday night open, you don't have to wait a couple of days for your ACH deposit to clear or your wire to clear in some cases. You'll be able to fund that, and that money will be readily available instantly.
Yeah, right. Yeah, that'll be a huge unlock for account funding. Velocity of money in 24/7 markets eventually.
Absolutely. As we're talking about kind of the future of markets of trading. And I think what that really relates to is blockchain infrastructure that facilitates this, right? You think about it as a security layer, more so a settlement layer, a little bit more efficient, faster, transparent. You're seeing a ton of announcements around the tokenization of securities. Less relevant, I would argue, for people in the US that can very quickly open a brokerage account with tastytrade, for example, fund that account and trade right away. But in terms of access by global traders or users to financial assets, US listed stocks, options, et cetera, the tokenization of some of these securities really starts to open up the gateways or the floodgates possibly.
Yeah. I think it's a total upgrade to markets globally. Market structure globally, obviously allowing more participants access to U.S. markets, U.S. listed companies. The U.S. has the largest, obviously, market in the world, most liquid, most active. I think it's all a good thing, right? Because to your point, U.S. citizens don't necessarily, have an issue with opening up a brokerage account and accessing these markets, but globally, people don't have access. So I think this type of innovation and tokenized stocks or 24/7 markets is the future, right? It's where everything's going, and I think it'll be interesting to see kind of what shakes out here over the next couple months. That Circle, you're looking at Circle right now, that Circle stock is interesting because...
Yeah, and shout out to Katana in the chat, said it's up $50 here, and we've got that on the screen. We just had Coinbase up there a second ago.
So what's crazy about that is the market cap of the Circle stock is like $48 billion, and there's only like $50 billion worth of US dollar coin. So it's like, it's getting to a level where potentially might be a little overvalued if you're just looking at kind of, market cap and what they're issuing on chain as far as US dollar coin.
Yeah, absolutely. I haven't paid that close of attention to the fundamentals here. I didn't look at the S1. I'm not an investor in Circle or a trader or anything like that in it yet. But clearly there's demand for access. There's demand to participate in this. And you, up to this point, really haven't had a lot of ways from the traditional side of things to invest in, or there really haven't been US-based crypto companies, right?
Right.
Coinbase, I think Galaxy just went public in the US previously on the Toronto Stock Exchange. You have a bunch of different miners that you can invest in as kind of like a BTC proxy, though not always even correlated. And Coinbase stock, as we mentioned, but you're probably going to see a Kraken IPO. You got the Circle IPO, presumably more are coming. It's a new day for crypto, or at least it has been for a few months here in the US. Dan, we got the chat fired up. We've got, they're all here. So shout out to everybody. Lone Sophos, Gregor, Katana. Who else is up in here?
Edward.
Dav, Edward, Emmett.
What's up, Emmett?
If you're not streaming on YouTube, get over there and type some crazy shit into the chat for us. Let's talk about markets, kind of go around the horn here. We sent out our midweek market update email this morning. If you don't get the Tasty Crypto emails, get on the list at tastycrypto.com. Little sign up box there. We send out 2 per day. Sometimes they're jam packed, other times we're busy, but we try to get the signals and the trading ranges and the correlations out a couple times each week with a bit of commentary. I personally enjoy writing some of these emails, but just taking a look at the performance dashboard, you called this out earlier, a bit of weakness. While there's excitement in the market, stablecoin legislation making its way through, crypto company stock prices exploding higher, seeing a bit of weakness when we look at some of the underlying cryptocurrencies, the tokens themselves. What do you make of that?
So I think it's just general pullback from the recent run we had, but I think if I'm looking at headlines here, the Fed left rates alone today, expects weaker growth, sticky inflation. That kind of is a headline that came across. I think we have the global conflict. Iran, Israel could throw some type of, pause on risk assets here.
Yeah, to that point, really quickly, let's just jump over to the correlation so everybody can see kind of how things have shifted in the short term. And that's a great point. If you get, while long term, it might be completely unrelated. I would argue doesn't really have that much of an impact on, say, the price of Bitcoin on the margin, the events themselves. If you get those risk-off headlines, we've had rising tensions, which have now evolved into tit-for-tat kind of escalation, missiles being lobbed back and forth. You've got Trump now weighing in, of course, on Truth Social or Twitter. I mean, it's ramping up. Don't get me wrong. We thought earlier in the week there might be a bit of a de-escalation, then quickly that was proven incorrect. You're seeing a strengthening in correlations here. So if we do get that kind of risk-off move for one reason or another, I don't think crypto is immune.
Right. Yeah, exactly. I definitely think that if we get a broader risk-off move in the markets, crypto is going to be affected, right? So I guess just pay attention to that. And I just think it's a little bit of a pause. I think we're still in a pretty bullish environment.
Yeah, absolutely.
Broadly.
Structurally bullish. We look at price momentum. We measure that through exponential moving averages and the crossovers. It's a simple way to look at it. It's somewhat backward looking, but keeps you on the right side of the trend, in my opinion. You've seen things go from bullish to neutral for Bitcoin and ETH. Everything else has been somewhat bearish from a momentum perspective for a while. But when I look at the structural trend in place, I want to look at weekly and monthly timeframes. And for Bitcoin, still, it's been bullish. Bitcoin market cap dominance, 65%. Bitcoin volatility is near the lows. In a more bullish environment, I want to see volatility pick up because it tends to rise with price at times, at least when price is really ripping. But we've been range bound. We're well off of those levels from early April, about 75,000. Took a shot at new all-time highs, and we've been, consolidating within that 1 week expected one standard deviation move, given the spot price and the implied volatility. So to kind of set expectations here, your upside is, you could probably call it 112. That's been the recent high that we came off of. But when you look at the current implied vol of 41%, you use a price of, let's call it 104.5, you're going to get about a $6,000 move. It's going to give you 98 on the downside, 110 on the upside, give or take. So well within reason, within the statistical probabilities as implied by the options market right now. It's not uncharacteristic in terms of what we're seeing.
For sure, yeah. I think just pay attention to the ranges. At some point, we'll get a little bit oversold here, and it might be a good spot to go back in and scoop some up. I still think ETH has a good bid on it, maybe.
Yeah, let's jump over to the browser really quickly. Take a look at our price chart for Ethereum. There you go. Yeah, just a big move to the upside to start the month of May. And it just seems like we're building that energy, Dan. We're going to go higher or possibly break lower here. But you're just not going to trade sideways forever.
Right.
I'm hoping for the break higher. You got to take out 2,800 and then, maybe the move's back to 3. Maybe it's ultimately to new all-time highs. You look at it this way, which is interesting, and you're seeing the same thing if we go down to ETH BTC. Also looks like, you're kind of priming for a move. This has been, as I like to call it, a very trashy trend over the last year. But let's say that you do run here, the narrative shifts. We know that the real world asset narrative is primarily related to Ethereum. Institutions are building. Stablecoins should start to influence some of that as well or support the idea. And do you get back to 500ths of a Bitcoin? That's going to, at the current prices, imply a $5,000 ETH price. Basically, 100% higher from where we are here today. Now, it's not the 10x that some of us are playing for in other areas of the market, but it's a pretty good return if you get it.
Yeah, for sure. I mean, I think looking at that ETH Bitcoin trend, it's been down only for over a year. And
yeah, look at the 5-year in here.
Yeah, I mean, that's
2022. Really, this time a few years ago was the top, and it's been Bitcoin up, ETH down in terms of that ratio.
Yeah. So, I mean, I think you've been saying this for a number of months now. It's like, might be a good time. So we'll see. It looks like that initial move has happened. Like, it looks like we've bottomed based on that chart, but still a long way to go. I still do think ETH is undervalued based on, like you said, all of the development happening on it. But there's a lot more competition too. There's a lot more stuff that has been developed. It's not the only place to develop smart contracts, trade on chain. So we'll see.
Yeah, the way that I like to look at things at times is to price them either in Bitcoin, and you can kind of find these relative value trades. But when you do that up to today, really, it's been Bitcoin over everything. So on a relative basis, Bitcoin has outperformed, up about 12% year to date. Everything against that is down pretty substantially. But you can look at Solana priced in ETH. And let's just throw our indicators on here for a second. We're starting to see some signs of weakness there too, which to me also signals maybe there's some room for ETH to run here. I look at Solana priced in Bitcoin. That's been bearish for some time. Not saying it goes lower, but that worked until it didn't. And so there's some signs here on a relative basis of weakness in Solana, strength in Bitcoin, some strength in Ethereum. Recently, when we look at the daily here, we were, if I zoom in a little bit, we had that bullish momentum signal, and you can see that it's now shifted to neutral. So keep an eye on that. But ETH definitely trading a lot better. Solana for now trading worse. I think these narratives just kind of ping pong around. But Bitcoin has held up and has been pretty resilient, even though we're whipping around within a $10,000 range. The local low in there over the last couple of weeks have been about 101 for reference. But you're just not seeing any signs in the option market that there's a big move one way or the other that traders are starting to position for. I think that the Fed and interest rate decision, monetary policy does matter, but we knew coming into this that there was no expectation for any cut.
Right. What are you looking for in the options market? Like, I guess if we take a look at IBIT, is it some big Is it IV? Like what
Yeah, I'm just kind of looking at IV, right? So if IV is going to increase or decrease depending on whether we have a lot of options buyers or sellers, right? And you think about a market like this where, yeah, sure, the bottom is zero. I don't think we go to zero, but there's typically more upside than downside. You often see this positive correlation with volatility and price action. And because there's that FOMO element and there's a speculative nature to it, you have people that come in, traders that buy up a ton of options on the tail. If it's IBIT, maybe that's in the 90s, it's 100 strike, whatever it might be. And you're playing for that big move and you're playing for that expansion of volatility. Same thing on the downside, right? If we were to start to see a lot of concern in the market and there's some fear, hedging activity, a bunch of traders coming in and buying put options, that's going to drive up put option premiums, put option prices. That's going to subsequently drive up implied volatilities on a per strike basis, as well as our kind of VIX style smoothed calculation when you look at 30-day. You're just not seeing that. What are you seeing? Well, you're seeing the opposite. Here is Bitcoin implied volatility. We're looking at this derived from Deribit. We've got to pull up the Volmex numbers here too. We had those guys on the show. That was awesome. Got to have them back. Let's just look at 30-day implied. Same, I mean, pretty much the same thing, right?
Right.
41%. If you look at this on a kind of IV rank basis, well, your 1 year high is closer to, let's zoom out a little bit. Let's call it about 70, and you're at the low. So your range is 70-40. You're at 40. IV rank of 0. If you're looking for a move in vol terms, maybe you get back up into the 60s, maybe you get to 70 or higher, those options would be a lot more expensive than they are today. So you're not seeing many signs in the options market that traders are positioning one way or the other for a big move, at least today.
Gotcha. Okay.
Now, sometimes that's reactive, and so you need realized volatility to then catalyze implied volatility. There aren't earnings announcements. Obviously, there's event risk at times in crypto, but there aren't earnings announcements where you would see premiums bid up ahead of them. I think it's typically kind of more of a reaction to news. But even with some of the recent weakness, it's not like everyone's rushing to hedge downside.
Right, exactly. Okay, interesting. Yeah, that the Volmex and DVol indices are good to take a look at too, just to give us an indication of, I guess, positioning and some of that in the price.
Yeah, here's on the other side though. Here's Ethereum, a little bit different. We'll put our indicators on there. So Ethereum volatility, kind of a little bit more of a bullish trend here at the moment. Another reason why I think, okay, maybe you could see, nothing's guaranteed, but maybe you could see a bit of upside in ETH on a relative basis here. We'd see that ETH BTC ratio move higher as a function of that too. But ETH vol is trending a little bit higher over the last couple of weeks, while Bitcoin volatility is at its yearly low.
Right.
You see that with realized as well. Just kind of going around here, Dan, real quick look at, here's Bitcoin market cap dominance stuck at the mid 60s. No signs that it's altcoin season just yet. A couple tokens that have been a bit of a bright spot. I don't know if you have any insight into what's going on with Bitcoin Cash, man, but Bitcoin Cash just ripping. Bullish.
I have no idea. I've never looked at that before.
You know, you could have bought it at 380 a couple weeks ago. It's $100 just about higher.
Yeah.
We're talking about Coinbase is up $40. Who cares?
Yeah. Yeah, Bitcoin Cash. Buy Bitcoin Cash, apparently.
Another one that's been on my radar here, Aave DeFi lending platform here. We'll just use the Coinbase price. It's pulled back, but another nice move where you got that signal just a few weeks ago back in May. Could have bought this, I think when we first saw the momentum flip, you were closer to about 250 and just caught, a nice rip there up to about, 320 or so. So that's another one that has shown some resilience in the face of, when we look at the weekly returns here for most alts that I track or that we offer through tastytrade, we're down double digits on the week, and it's been kind of bloody on the 1 month and 3 month basis too. What else are you trading? You buying any NFTs? What, like everybody that I talk to is like, what's going on with the NFT market? You're in that space. You got a couple minutes on NFTs before we wrap up?
Yeah, I mean, I am just looking. Well, NFT NYC is next week.
Okay.
So I feel like there's always people that launch projects around that because they'll want to go and like promote it in New York. That's when, for anyone that doesn't know, that's the largest NFT conference in the world, New York City next week. So a couple projects have launched. I'm collecting a few things, nothing major, but yeah, I mean, I don't know. It's kind of quiet out there. It depends on what chain, right? So like I think ETH mainnet typically is reserved for like artists, generative art, stuff that's a little bit higher value, people that have they got rich in ETH, so there's that wealth effect.
Yeah.
Base, Solana, that I would say like is a little bit more I guess lower value NFTs, stuff that's like tied to a product launch or tied to a game or community or some type of like token gated content type thing. Just internet memes, things like that. I look at NFT floor price if you want to ever bring up like, the major collections and just see how they're doing. But
so you kind of track, so it's a way to get a sense of the NFT market. You track blue chip prices of things like Bored Apes, CryptoPunks.
Yeah.
Okay.
CryptoPunks, Bored Apes, Pudgy Penguins, Chromie Squiggle. Those are like top 4.
Are they moving higher? Haven't looked recently.
Just kind of sitting in the same spot.
What's a CryptoPunk cost?
$100,000
in current ETH price.
40 ETH.
Okay, so but given it's $100,000, given ETH's 2,500 or whatever,
Right.
so ETH goes to 5, and
Yeah.
maybe that per ETH price comes down because I think a lot of people still look at things in dollar terms.
But this is like
That's expensive. I mean, maybe it's not expensive. Maybe that's cheap. But
I think it's cheap.
Okay.
Considering
you've heard it here first.
Yeah. I mean, I don't want it to be skewed like it's not cheap in fiat terms if you're like a
Right,
normal
but from
person.
a trading perspective, I mean, what's the high in there for CryptoPunks?
Like 80 ETH, 100 ETH.
Okay, some of these have sold for over $1 million, right?
Right, yeah. 80 ETH. 107 ETH was the top in 2021.
Okay. Well, Dan, we got to jump off. Unfortunately, we've run out of time, but I do want to talk a little bit more about NFT trading and more so like the digital art market, because there's some massive opportunities there. I think people have been asleep. Everybody thinks it's about profile pictures, and they're still stuck in the kind of 2021 bubble post FTX collapse. But interesting opportunities abound. So we'll talk about that when you're on the show next.
Wealth effect's huge there.
Yes. Yeah, I want to dig into that a bit more. But that's going to do it for our show. Thank you all for watching and tuning in on YouTube, joining us in the chat. We will be back on Monday. Until then, I'm Ryan.
I'm Dan.
Peace.
You can get up to $4,000 when you open and fund a new account with Tasty Trade. That's 4,000 buckaroos, 4,000 bills, or clams, 4,000 in dough or cheddar, not the cheesy kind. 4 large, 4K, 4 grand, which is no small thing. Open and fund a new Tasty Trade account and get on the platform for traders who just want to trade. And did we mention a bonus of up to 4,000 smackaroos? Tasty Trade. Make your move.
All right, Julia. All right, Nick. All right, Mike. All right, Jamal. All right, Glenn. What was the last trade that you made?
Oh, it was bad.
Oh, man.
I bought SQQQ. It's like a 3x inverse ETF. I feel like I get shit on for the inverse ETF trades. They're not, I wouldn't say they're always good trades, but I'm like, I kind of don't want to get in the options right now, but I want some leverage.
I got long some Apple, and it just happened to work out in the last about 5 minutes here. So I sold a wide put spread out in May, and it basically lost half of its value in the last 5 minutes.
My last trade was closing out a meta calendar spread that was worthless prior to the 500-point rip in the E-minis.
Last trade I placed was I closed out a put spread in SPY. It went well. I regretted to say it was a long put spread that I put on yesterday into the big move, and I closed it out since we retreated in price today, and it's worked out well.
Short gold options.
How'd it pan out for you?
We're still alive, but we're not looking good.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
Global markets never sleep. Explore them with Forex, now available on Tasty Trade. Get in on over 80 Forex pairs, 24 hours a day, 5 days a week, with the Forex platform that adapts to your style and speed. FX marks the spot. Trade it on Tasty Trade.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
You can get up to $4,000 when you open and fund a new account with Tasty Trade. That's 4,000 buckaroos, 4,000 bills, or clams, 4,000 in dough or cheddar, not the cheesy kind. 4 large, 4K, 4 grand, which is no small thing. Open and fund a new Tasty Trade account and get on the platform for traders who just want to trade. And did we mention a bonus of up to 4,000 smackaroos? Tasty Trade. Make your move.
The future of trading is here. Join Mike and his whiteboard, plus the Tasty 2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
Global markets never sleep. Explore them with Forex, now available on Tasty Trade. Get in on over 80 Forex pairs, 24 hours a day, 5 days a week, with the Forex platform that adapts to your style and speed. FX marks the spot. Trade it on Tasty Trade.
Oh, yeah. Tasty Nation, good morning.
Dear Karen, thank you so much for the relationship advice. Of course, since you met your husband in high school, I should obviously just go back to high school. Can't wait to win the Nobel Prize for my development of a time machine. Signed, Regina.
Sometimes it feels good to get smart. Get even smarter with live trading insights and some live taunting.
You're mistaking me for someone who cares.
From the smart mouths at Tasty Live.
If you missed the live show, here's our cherry on top weekly recap.
Hola!
Look at you guys looking like spy versus spy.
I'm in the UK. Vanetta, I got in. They let me in.
So how's the vibe in London? How's the weather? What's the tea?
So Britt and I are getting off the plane. We're like, should we wait for Batista's? And I'm like, she's like, should we wait for the Batistas? It's the right thing to do. And I'm like, all right, yeah. And it's like European vacation. You know, we are traveling with that, with that crew. So I have a little suitcase and a backpack. Britt has a little suitcase and a backpack. The Batistas, 75 bags. It's like coming to America.
We have a rule in the Batista house. The wife has to pay for the vacation when we're on vacation. So she has one suitcase full of shoes.
Got the need for speed? No problem! At Tasty Trade, you can turn smart ideas into real trades with just a few clicks. Wow, that's fast. Tasty Trade, make your move. The market doesn't stop, so why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
Class is in session. Dr. Jim Schultz is bringing the heat to Options Crash Course Live. This 90-minute show features Dr. Jim in his professional prime. All of the gimmies, none of the gotchas. Come early and grab a drink with Dr. Jim before class and stay for Q&A. The event is free, but space is limited. Register today at tastylive.com/events. It's not a lecture, it's a lifestyle.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
I got Joe in Houston. What's up?
Just want to call in and say I really appreciate everything. I started trading and learning from you guys about 6 years ago. You know, it was you guys' work and the platform that got someone like me that didn't really know anything about the market capable of really outperforming the market now for, 5 out of the last 6 years. And so I really appreciate you guys. I think of another company where I can pick up the phone and call the CEO, the trade desk, and reach somebody as quickly as I can there. So just really appreciate everything and what you're doing for guys like me out here. What you're doing is really spectacular. So really appreciate it.
Thank you, my friend.
I really appreciate it.
You made my weekend, man.
The beauty of Thinkorswim was that we were different. From the name to the front end technology was clearly what we wanted as traders. Second time around, I think we did a better job. Yes, we are known for our ability to support complex derivatives traders, but we also have the tools for somebody who's brand new who wants to come in on the first floor and work their way up to the top of the building.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
The amount of time I spend interacting with our customers via email or anything else is pretty much my entire life.
To be so powerful and so valuable, and then to be that approachable, just amazing.
Where else are you going to be able to email a CEO, get response back?
But you know what? Before he even knew who I was just some idiot trying to learn how to trade. And he still would email and help me learn and everything like that.
Some people say it's nuts, some people say it's insane. That's what I do.
In the world of investing, a beast lurks between the numbers, ready to pounce. Some traders hide from it, some ride it. If that's you, join us on Tasty Trade. Genius loves company.
Stephen and Lan, thank you so much for holding.
My pleasure, guys. And let me go on record as saying I think you've got Tasty Trade is the best brokerage, and you guys have the best content. And I'm not here just schmoozing. Y'all are the best on the planet, period, for what you do. Go on record as saying that. Tom,
Thanks.
you were the great disruptor when it came to forming Thinkorswim and then Tasty Trade. You're an innovator.
I appreciate you calling in. Good stuff as always. Thanks, man.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and tastylive web store is now live. New merch, bold designs. Did we mention all net proceeds go